Ever found yourself mulling over the idea of taking a loan from your 401k account? You're not alone. In the past year, we've seen a 14% increase in Americans tapping into their workplace retirement funds for loans. And why is that? Well, it appears that increased credit card debt, higher interest rates, and the resumption of student loan payments have played a significant role in this trend. But before you make a decision, it's crucial to understand what a 401k loan is and how it works. A 401k loan isn't your typical loan. It's borrowing from your future self. Imagine a piggy bank, but instead of coins and dollar bills, it's filled with your hard-earned retirement savings. That's what a 401k loan essentially is, dipping into that piggy bank before you've actually retired. But what exactly is a 401k loan? It's an avenue that allows you to borrow from your own workplace retirement fund. The catch? There's no credit check involved, and you won't incur taxes and penalties. That's right, your credit score stays intact, and Uncle Sam won't be knocking on your door for his share. Now there are some limitations to this borrowing spree. You can't go all in and empty out your retirement fund. The loan amount is typically capped at $50,000 or 50% of your vested account balance, whichever is less. So if you have $100,000 in your 401k, you can borrow up to $50,000. But if you only have $60,000, your loan limit would be $30,000. The repayment process, on the other hand, is pretty standard. The loan is generally repayable within 5 years, and you'll need to make regular payments, just like any other loan. If you leave your employer while you still have an outstanding loan, most plans require you to repay it in full, pronto. One thing that sets 401k loans apart from others is the interest rate. It's usually lower than those on credit cards, making it an attractive option for those drowning in credit card debt. And the best part? The loan doesn't affect your credit score. Sounds straightforward, doesn't it? However, taking a 401k loan should generally be considered a last resort. Yes, it may seem like an easy way to get your hands on some cash, but remember, by taking a 401k loan, you're borrowing from your future self, from your retirement. And that's a decision that shouldn't be taken lightly. So when does dipping into your retirement savings actually make sense? It's a question that might have crossed your mind in times of financial strain. While experts often advise against it, there are certain circumstances where a 401k loan could be a viable option. Picture this. You're faced with a medical emergency. Your insurance doesn't cover all the costs, and you're left with a hefty bill. Your savings aren't enough, and you're hesitant to accumulate high-interest credit card debt. In this situation, a 401k loan might be a lifeline. It allows you to access funds without a credit check, and the interest rate is typically lower than that of a credit card. Let's consider another scenario. You're in the market to buy a home. You found the perfect property, but it's a seller's market, and you're competing with multiple cash offers. You haven't sold your current home yet, but you need to make a cash offer to stay competitive. A 401k loan might be your ticket to home ownership. It's worth noting that the IRS allows a longer repayment period for loans used for home purchases, which could make this a more manageable option. Another instance could be if you're looking to make a cash offer on a property without selling your current home. In a high-demand, low-supply market, cash is king. A 401k loan could provide the funds needed to make a competitive offer, giving you a leg up in bidding wars. But remember, these are typically exceptions, not the rule. It's important to consider other options first. While these situations illustrate when a 401k loan might make sense, they should be viewed as last resorts. A 401k loan can have significant implications for your long-term financial health. So before you decide to borrow from your future self, make sure to explore all other avenues. A 401k loan should only be considered when you've exhausted all other options and are confident in your ability to repay the loan without compromising your future financial security. Before you decide to borrow from your future self, have you explored all other options? It's important to remember that a 401k loan should be seen as a last resort. There are several alternatives to consider that may be a better fit for your financial situation. The first alternative is a personal loan. Personal loans are typically unsecured, meaning they don't require any collateral. They often come with fixed interest rates and a set repayment period. Plus, the loan amount can be quite flexible, allowing you to borrow as much or as little as you need. However, interest rates can be higher than a 401k loan, and your credit score will influence both your eligibility and the interest rate you're offered. Another option is a home equity line of credit, or HELOC. If you're a homeowner with some equity in your property, this can be an attractive option. HELOCs allow you to borrow against the equity in your home, often at a lower interest rate than a personal loan. But remember, your home is the collateral here, so if you fail to make repayments, you could risk losing your property. If you're in the market to purchase a new home and want to make a competitive cash offer, you might consider partnering with a real estate investor. This involves teaming up with an investor who provides the cash for the purchase up front. You then repay the investor, typically with interest, over an agreed-upon period. This strategy can help you secure a property in a competitive market, but be mindful of the terms and conditions of such partnerships. Each of these options has its own set of pros and cons, and the right choice depends on your personal financial situation, your credit score, your tolerance for risk, and your immediate and long-term financial goals. Weighing your options is key. Your retirement savings should ideally remain untouched. Remember, a 401k loan might seem like an easy solution, but it's not without its risks. It's essential to consider all available alternatives before making a decision that could impact your future financial security. If you've considered all other options and decided a 401k loan is your best bet, there are a few things to keep in mind. Firstly, it's crucial to continue making contributions to your retirement account. While it might be tempting to ease off on contributions while you're repaying the loan, remember that doing so could significantly impact your long-term financial health. After all, these contributions are not just about the money you put in today, but also about the compound growth that this money can generate over time. Secondly, make sure you have a solid plan in place to repay the loan in full. While a 401k loan might offer a lower interest rate compared to other types of loans, it's still a loan. Failing to repay it can have serious consequences, including taxes and penalties. Additionally, any unpaid loan balance could be considered a distribution and potentially subject to income tax. Another important consideration is job stability. If you leave your employer before the loan is fully repaid, whether by choice or not, the remaining loan balance is usually due in full. If you're unable to repay it, the unpaid amount could be considered a distribution, subject to taxes and potentially an early distribution penalty, depending on your age. Finally, consider the impact on your retirement savings. A 401k loan may seem like a quick fix, but remember, the money you're borrowing was meant for your retirement. Borrowing from your 401k could mean less money available when you retire, especially if you're unable to make regular contributions while repaying the loan. A 401k loan can be a lifeline in tough times, but remember, it's a decision that should be made with careful thought and planning. So, is a 401k loan the right choice for you? We've delved into the intricacies of a 401k loan, what it is, how it works, and when it might make sense. We've also explored alternative options and shed light on important considerations before taking such a step. Remember, a 401k loan allows you to borrow from your retirement fund, typically up to $50,000 or 50% of your vested account balance. It's a tool that could potentially help in situations like medical emergencies or home purchases, particularly when other loan options are not viable. However, it's crucial to understand that this route is generally recommended as a last resort. Why? Because it could impact your long-term retirement savings. If you leave your job, the loan usually becomes due in full, which can put you in a tough spot. Alternatives such as personal loans, home equity lines of credit, or partnering with a real estate investor could be worth exploring first. These options might offer a more flexible and less risky approach to addressing your financial needs. Taking a 401k loan is a significant decision that requires careful thought and planning. It's essential to consider your current financial situation, future goals, and potential risks. Remember, the interest rates on 401k loans may be lower than credit cards and don't affect your credit score. But it's also crucial to continue contributing to your retirement fund and ensure the loan is repaid in full to avoid any penalties. Ultimately, the decision is yours to make. Be diligent, be informed, and choose wisely. Your future self will thank you. We hope this video has shed light on the ins and outs of a 401k loan and helped you in your decision-making process. If you found this content beneficial, don't forget to hit the like button. To stay updated with more such informative videos, make sure to subscribe to our channel. And if you know someone who might benefit from this information, don't hesitate to share this video with them. Remember, knowledge is power, and sharing it can make a significant difference in someone's life. Thank you for watching.